All right, here we go. So we have 4 more budgets to do. We've just finished the direct labor budget. This is the manufacturing overhead budget. Okay, so we have to figure out a whole bunch of little details for this overhead budget. So we have, if you think back to chapter 3, we have a variable manufacturing overhead rate, and we have fixed costs associated with manufacturing overhead. So we're going to put both of those in here. We're going to basically come up with what we did in chapter 3, which was what is our estimated manufacturing overhead, all the costs, and then we're going to say our cost driver at this company is direct labor hours. So we want to know our total direct labor hours for the year and come up with a direct labor rate. I'm sorry, a predetermined overhead rate. All right. So first thing we do is we say, what's our budgeted direct labor hours? And these are going to be what we have forecast we will need, what we have budgeted, the hours that we will need in order to make that production. Now, you'll notice I'm using the hours that we calculated. I don't care what we're paying our employees at this point. I'm just using the actual hours that we calculated. 1,300, 2,300, 1,450. Here's our variable manufacturing overhead rate. And here's our variable manufacturing overhead dollars. Now I'm going to throw in my fixed costs here. 50,000 fixed manufacturing overhead. And I'm going to get total manufacturing overhead costs here, 251,000. Okay. So now I'm saying for the quarter, I mean, this would be done annually, but for the quarter, we're just going to show it. Our estimated manufacturing overhead is $251,000. Our estimated labor hours required are 5,050. I got that off of the labor budget, and this is giving us our predetermined overhead rate, $49.70. Super high, right? It's when you consider this is per hour. So for every direct labor hour, it's $49.50 that we're going to apply manufacturing overhead. All right. Now, on this budget, we actually go on to show, we add some additional information on the manufacturing overhead budget so that we can use it later for the cash budget. But we're essentially done with the manufacturing overhead budget in terms of coming up with that predetermined overhead rate. But I'm also looking at down the road, I've got to prepare a cash budget. So I'm going to subtract the non-cash costs, and the problem gave those to us. They said mostly depreciation, non-cash costs. And then I want to come up with our cash disbursements here. Okay. All right. Does that make sense, Abby? So we're using this budget for 2 things. One, to come up with the predetermined overhead rate, and the other to inform the cash budget. But interrupt me if you have questions. All right. So we're moving on to the finished goods budget. And if you look in your course pack, there's a lot of boxes there, but we really don't use them all. We we're only going to use a few in this course pack. But we want to know what we have in finished goods inventory. But first, we have to come up with a unit cost for our cheesecakes. Not price. We know price. We're coming up with a unit cost. So we know that the cheesecakes consist of 5 pounds of direct materials, which standard cost 40 cents. So $2 worth of material. We also know that for every cheesecake, it takes 3 minutes of direct labor, and our labor cost is $10. So that's 50 cents worth of labor per cheesecake. And we've just calculated our predetermined overhead rate. Okay, so here's our predetermined overhead rate, $49.70. And we're using labor, so 0.05 labor hours, 3 minutes. So $2.49 of overhead. So our cheesecake standard cost is about $5, $4.99. Okay. So the question is, what is our the cost of our finished goods inventory. Okay, so what is our finished goods in units? We have to go back and look up that number, which we get off of the production budget. We ended up June 30th. If you page back to the June 30th, to the production budget, your ending inventory for June is 5,000 units. So therefore, our finished goods inventory, our T account for finished goods, has 24,950 in it. Okay. All right. Moving on to the sales and admin budget. Okay. So selling and administration is all the period costs. These are costs that are not part of manufacturing. And the problem's just going to give you most of the costs. You've got variable expenses, 50 cents per unit sold. So what would be an example of that? Could be packaging that goes on the product, or brochures that go on the product. Could be any sorts of warranty that's associated with the product, where they set aside money for warranty. We wouldn't have warranty on a cheesecake, but for other products. Fixed selling and administration, there are 70,000 a month. So they're just giving you big dollars here. We're not getting into the operating expenses of, training or depreciation expense. They're just giving you the totals. And then they say the fixed selling and administrative expenses include 10,000 that are primarily depreciation, that are non-cash. Okay. Again, we're going to use that at the bottom of the schedule, because we want to use that later for the cash budget. Okay. All right, so budgeted sales, where do we get that information from? The sales budget. Variable selling and administrative costs, 50 cents. So now we know our variable expenses. Fixed expenses, 70,000. Total 80,000. And then these last two lines, we're going to use them later for the cash budget. Subtract the non-cash expenses, leaving us with cash outflow of 70. And then May and June, again, sales budget is now a lot higher in June. I guess they sell more cheesecakes in June. And so that raises the variable cost, but you can see the fixed costs don't change. And then we subtract the depreciation expense to get us the cash outflow for selling and administrative. And June, our sales dropped to 30,000. Fixed costs stay the same, and we subtract. Okay. And that's the selling and administration budget. So now we're down to the last budget, which is the cash budget. I just want to clarify that the PowerPoint slides go on and do the budgeted income statement and balance sheet, and you are more than welcome to take a look at that. But I just test you on the individual budgets. Okay. All right, here we go, cash budget. So why do we need a cash budget? And that is a budget that I'm really familiar with. You need a cash budget because you need to know if the money coming in that you expect to come in and the money that you expect to go out gives you a balance, a positive balance. Because if you're spending more than you're bringing in, you've got to make some quick changes. Now, every company is going to have seasonality. Okay, they're all going to have seasonality. And so what we do when we have months where we spend more than we take in, that's usually just a timing issue where you just have to say, we made a bunch of sales this month, so of course we had to spend a lot of money to build the product, to buy the materials, to pay the labor, but we're going to collect that money next month, so it'll all work out. Meanwhile, you have to pay your employees, you have to pay your suppliers. And so part 3 and 4 is where we say, hey, we may need to borrow money from our bank. And most banks have a line of credit where companies can borrow up to a certain dollar amount. So what we do is we figure out on those months where we need to borrow money, we go to the bank. Usually it's an automatic relationship that's already been set up, and we borrow $10,000, $20,000, $30,000 to make sure we can meet our payroll and our check needs. So here we say we have an open line of credit, $75,000. And typically companies arrange what's called a revolving line of credit, where you can borrow 10,000, and if you can't pay it back the next month, you can borrow another 10 or 20 up to borrowing 75. You can't borrow more, you can't owe the bank more than 75 in this example. Okay. But you can borrow more than once. So you pay the bank 16% per year, not per month. And our policy at this company is $30,000 minimum cash balance at the end of the month. That's just kind of safe number. And just to make calculating interest easier, we borrow on the first day of the month and we pay back on the last day. And then here's some additional information. We're going to have a cash outflow in April of a dividend. We're going to have cash outflows of equipment purchases in May and June. And we start off the month of April with a $40,000 cash balance. Okay. So this one goes pretty fast, and it's pulling from a lot of sources, Abby. So what I would say is, when you're doing this, make a lot of notes as to where this is coming from. And you may need to go back and go through the slides again. So beginning cash balance, given. Cash collections, you go back to your cash receipts budget and pull that for April. And that tells you how much cash you have available, okay? Now we're gonna go look at all these sources. We're gonna go to the cash disbursement budget. And we're gonna see in April what we expect to spend, okay? We're gonna go to the direct labor budget and say, what did we expect to spend? Remember, we're paying that minimum $1,500 a month times 10, okay, for April. Even though actual for April was 1,300 hours, we promised to pay our employees a minimum of 40 hours a week, okay? Manufacturing overhead budget, that's off the overhead budget, and selling and admin. And all of these are just the cash outflows. We're just in cash land now. We are not doing expenses. We're doing expenses minus the non-cash expenses, okay? And then here's that dividend, and that was additional information for this budget. So we're saying this is what we're spending, $230,000. But oh, look, we're only expecting to collect $210,000. So we have a shortfall of $20,000. So in order to meet our minimum goal of $30,000, we have to go out and borrow $50,000, $20,000 to make up the shortfall, and then another 30. So we're going to borrow $50,000, and we're not paying anything back because we're obviously are borrowing, not paying back, and we're not paying interest yet. So here we go, ending with 30,000. Now that 30,000 ending cash balance is going to roll up into May as our beginning balance. And we just roll the numbers through again. Cash collections comes from cash receipts budget. Materials comes from cash disbursements budget. Labor comes from labor budget, overhead from overhead budget, and so forth. And then here's that equipment purchase. 400, here we have exactly 30,000. We don't need to borrow any money, but we also cannot pay the money back. Okay, so there's our ending balance, and it'll come up here for June. And this will roll through 30, 33, and this is coming off cash receipts budget and all the other budgets. Now we have an excess of 95,000. So we can pay our 50,000 back, and here it's showing going out repayment. And then this 2,000, it looks like the company only borrowed the 50,000 for 2 months, but remember, you borrow on the first day of the month, which would be April 1st, and you pay back on the last day of the month, which would be June 30th. So April, May, and June is 3 months. So there's our annual times 3 months is 2,000, and that's a cash outflow for interest. Okay. All right. And then the totals. And we're not going to do the income statement, although it's lovely. And we're not going to do the balance sheet either. All right. I'm going to pause that.